Good afternoon. This is Kendi with Collab Lending, and we're going to talk about red flags to avoid when financing your home. And so as a buyer, it's really important that you know that there are things that can drastically stop your financing from proceeding or cause a lot of complications moving forward. So it's important to review them and discuss them so that you know what to avoid as you go through the process. First, we'll talk about the difference between a pre-qualification and a pre-approval, because there is a really big difference between the two. A pre-qualification means you've given somebody your income and told them approximately how much you have to put towards the transaction, and it may or may not include a credit authorization to review your credit, which means that they only have part of the information that they need to be able to make a decision. A pre-approval, on the other hand, means that you've verified your income and assets by providing bank statements, 401k information if you're pulling from a retirement account to purchase, as well as tax returns, W-2s, and recent pay stubs. All of this is important because there are different types of loans that are available based on the type of income that you have, and we need all of that information to make sure that we're calculating your income correctly. The other thing is a full credit report. And by that, we mean a 3-merge credit report. We get a report from Equifax, TransUnion, and Experian. And that gives all of the information that's being reported to all of the credit bureaus. It's important that you do a full credit report and not a partial, because not all information is reported to this, all 3 credit bureaus. And so what's interesting is there are some accounts that only report to TransUnion, some that only report to Equifax and Experian. And then the last thing that's part of the pre-approval process is having your loan run through an automated underwriting system for an approval. And this is important because it takes all of the information from your credit and all of the information that's been input for your income and assets and put that together to determine whether your loan would be approved once it's reviewed by an underwriter. And so again, the difference between a pre-qualification and a pre-approval is really that the information that you're giving has been verified and has been with documentation, and that we know that it's calculated accurately. So what's the other big thing that can have an impact on your approval and throw up some red flags? Well, your credit score. You may not know this, but your credit score will determine each of these things in the mortgage process. What kind of mortgage you qualify for, what that interest rate on that mortgage will be, how much your mortgage insurance will be, what your homeowner's insurance will cost you, and if you have to have flood insurance, what the flood insurance would cost. And that's why it's important to have an idea of what your credit score is, because we can help to determine where these costs are, even if you don't necessarily go and get a quote, for instance, from your homeowner's insurance agent. Based on your credit score, we can determine where that's going to be in a range. One of the things that often happens is you do a pre-qualification, and it's based mostly on assuming that you've got somewhere between a 660 to 700 credit score. And what if when you do your 3-merge report, your credit score is actually lower than that, the middle score, which we use for your mortgage financing. If it's lower than that, then all of your costs are going to increase. And as those increase, that might have an impact on your ability to qualify, because if your interest rate goes up and your mortgage insurance goes up and your homeowner's insurance goes up, you might no longer fit within the required debt to income ratio for the house that you're purchasing. So it's important to know what your credit score is. Your liabilities. These are the things that you owe that report to your credit report. So if you have high balances on accounts, it's important to know what those are. Very often, what happens is you're not necessarily acutely aware of exactly what your balance is on accounts. Some people have accounts like an American Express account where you can charge, but you pay it off every month. It's important to know that if you have that high balance account, that you also have the assets to pay it off, because we have to verify that, or we have to count that high balance in your debt. Other things that can impact your ability to qualify: past due accounts, collections and judgments, any negative information that would be viewed on your credit report. Things like delinquent IRS taxes, if you've had a short sale, a foreclosure, or a bankruptcy. And so it's important to communicate with your loan officer, your mortgage broker, exactly what your financial picture looks like and that they aren't surprised. One of the big things that we look at when it comes to making sure that you don't have any red flags is, what does your income look like? We do require a 2-year employment history for all loans. And you need to explain if there are changes in your income. These are the ones that really have an impact. If you have commissions and bonuses, are they consistent? Did you receive a bonus last year, but you don't receive a bonus this year? Is it that it's an annual bonus and you get it at the end of every year, so it reported for last year's, but you don't get it until the end of this year? Are there decreases in your annual income? Are there things that you received last year? You know, it's one of those things where a lot of employers provided additional funds through COVID for one reason or another, whether it was a cost of living increase, or, you know, some extra pay because you were working through some difficult situations. If you don't then have an increase in income this year, we'll need to be able to explain why your income was higher last year than it is this year. Changes of employment, particularly the frequency in your change of employment, can have an issue for some loans. And so it's important that we look at consistent income. If you're thinking about changing jobs during the loan process, that's another big red flag. You want to make sure that you let your loan originator and your processor know upfront so that they can tell you what kind of documentation they'll need to make sure that it doesn't completely stall or halt for a moment your mortgage process. I can remember that there were several situations where you know, we send out these do's and don'ts at the beginning of the loan process, letting you know things that you should and shouldn't do. And I've had clients where we go to do a verification of employment, and that happens at different stages throughout the loan process. And we've had someone where we've reached out to them and they're, you know, not telling us anything new is happening, but we reach out to the employer and then we find out that they no longer work there, or that they've given their notice. And haven't informed us of their new employment. And so it's really important that you keep this information up to date throughout the loan process. If you have any gaps in employment, it's important to note the length of that gap and the reason for that gap. It's obviously going to have an impact on your average income for that year. But what's really important is noting why that gap happened and if it is likely to continue, because it's going to have an impact on your ability to qualify. Another thing that people often overlook is when we're talking about income and someone asks, like, how much do you make? If you're a salaried employee, you probably say, like, I make this much, you know, $30,000, $40,000, $50,000 a year, because that's your negotiated salary. But you often overlook the deductions that are on your pay stubs, things like child support. If there are any garnishments for against your wages for delinquent taxes, et cetera, all of those things are deductions on your pay stub. And that's why it's really important to look at not just your W-2s and your tax returns, but your pay stubs to see if there are any of those deductions that need to be, you know, counted as additional debt. Assets. This is what's really interesting about assets in the mortgage process. You need to show a 60-day account history for any of the funds that you're using towards your mortgage transaction. And that means once you're reviewing that account history, whether it's a statement or a printed summary that comes from the bank, everything gets checked, verified, and kind of looked at with a fine-tooth comb. And so transfers that you have between accounts, cash deposits. The newest thing would be not cash deposits, but electronic deposits that come from PayPal, Venmo, Cash App, Zelle, those sorts of things. And then gifts that you receive. It's important to note what's happening in the account, because you're going to have to explain it. And so a lot of us use, Cash App, PayPal, Venmo, and Zelle to split dinner with friends, or, if an assortment of things. During the mortgage process, you want to keep that to a minimum as much as possible. What I tell my clients is, if you frequently use these apps, leave some cash in those accounts and use that balance that's in your Zelle, or, I'm sorry, not your Zelle, but like your Cash App, your Venmo, your PayPal. Leave a balance there to use for those transfers back and forth. Don't transfer it all back into your checking account until after the transaction. This way, it's a lot easier to verify where those funds are coming from. Now, if you're using gift funding towards the purchase of your house, it's important to note that you need to receive that gift in a particular method. It varies based on the type of loan, but essentially those funds need to be received by you prior to closing, and it needs to be verified as received in your account and the funds cleared. It may or may not require a 30-day account history from the giver of the gift, verifying that they haven't borrowed the funds to give them to you. And so when it comes to assets, it's really important to pay attention to the information in the statements. And, when in doubt, ask. And this is another reason why a pre-approval is very important. Have someone review it at the beginning of the mortgage process to be able to tell you, okay, I see that you have a tendency to do these things. These are the things that you should avoid through the mortgage process to save you from having issues down the line. You can avoid red flags by gathering all of your financial documentation. Again, that is income documentation, 2 years of tax returns, 2 years of W-2s, 30 days of pay stubs, and all of that to get fully pre-approved, which means that you've talked to a mortgage broker that pulls your credit and reviews all of your financial information, along with running your entire loan against an automated underwriting system and getting an approval. And then any additional documentation that they may require from you, such as if you're getting a gift letter and the bank statement from the giver of the gift. It could mean additional explanations with regards to your financial information, or reaching out to your employer for a verification of employment, a written verification, to identify the different types of pay that you receive and the continuity of it. And then it's important to make sure that you keep all of your financial documents up to date up until closing, because we check, verify, and re-verify all of that information. If you have any questions at all, please feel free to reach out to us at the CoLab Lending team. Again, I'm Kendi Alvarez with CoLab Lending.